Imagine that you put $1,000 on your deposit and want to trade. Should you use the entire sum at once? Probably not. Remember how we spoke about the risk management. So, which position size to choose then? Step 1. Don't risk more than 1 or 2% of your deposit for one trade. This way, even if some of your trades aren't successful, you won't lose all your money and will be able to keep trading. For example, if your deposit is $1,000, risk no more than $10, 1% of account, on a single trade. Step 2. Establish where the stop loss will be for a particular trade. Then measure the distance in pips between it and your entry price. This is how many pips you have at risk. Based on this information and the account risk limit from step 1, calculate the ideal position size. For example, you want to buy euro-dollar at 1.11 and place a stop loss at 1.1050. The risk on this trade is 50 pips and you can risk $10. Step 3. And now you determine position size based on account risk and trade risk. Remember that there are different lot sizes. A 1000 lot micro lot is worth $0.1 per pip movement. A 10,000 lot or mini lot is worth $1 and 100,000 lot standard lot is worth $10 per pip movement. This applies to all pairs where the US dollar is listed second, for example euro-dollar. If the US dollar is not listed second, then these pip values will vary slightly. Note that trading on standard lot is recommended only for professional traders. Use the formula you see on your screen. Assuming that we have 50 pips top in the euro-dollar, use the following formula for the size of the position. The position size is in micro lots because the pip value used in the calculation was for a micro lot. For the number of mini lots, use $1 instead of $0.1 in the calculation to get one mini lot. Here is the formula. The pips at risk will often vary from trade to trade, so your next trade may only have a 20 pip stop. Use the same formula.
Stay tuned for other titles in this series. They're on the way.